And if you are in the retirement red zone, meaning that you plan to retire in the next 5 years, or maybe you have been retired for the last 5 years, please give us a call so we can help you strengthen your retirement plan, which, and this is something that I've run into, and I've got to clarify this. Sometimes we'll say financial plan on the show, or people will come in and when I meet with them, they'll say, "Yeah, I've got a finance." I'll ask them, "Where's your retirement plan?" And what they'll do is they say, "Well, here it is," and it's basically a financial plan. So you're probably wondering, what are the differences between the two? Because there is a difference, and it's pretty obvious and maybe subtle when you first look at that. And so what I did is I did the easy thing. I went to Investopedia, and I got the definition of both. So this won't be coming from me, but what you'll find is if you go there and type those two in, you'll get some of these bits of information. Now, a financial plan, as it's defined in at Investopedia, is documents an individual has on their long-term financial goals, and that also creates a strategy for achieving them. The plan should be comprehensive. Yes, it should, but also individualized. And that means everybody's got a different situation to reflect the individual's personal and family situations, risk tolerance, and future expectations. The plan starts with a calculation of the person's current net worth, cash flow, and ends with a strategy. And as we go through the New Year's resolutions, you'll get some hints of this about what a financial plan does. Now, what's a retirement plan? What's the difference there? Well, retirement planning refers to financial strategies of saving, investments, and ultimately distributing the money meant to sustain oneself during retirement. And that's coming from Investopedia. There's many popular investment vehicles that you actually start when you're doing your financial plans before the retirement red zone. And retirement planning, as they say, takes into account not only assets and income, but also future expenses, liabilities, and life expectancy. So it's a little different than the financial plan. So you're probably wondering, what's the big difference between the two? And I'm going to, you just have to think about that one for a little bit. And what we'll do is we'll go through a few things to explain that difference to make it a little bit more clear to you. So when you first have a financial plan, you may be in your 20s or 30s or 40s, and that's get started. And you start in something that they call the accumulation phase of your life, where you're accumulating retirement savings. And you're thinking, well, then you're accumulating retirement savings. That's the same as a retirement plan. Well, not quite. Hold on for just a second. I know you're asking that. So what happens is you're in accumulation stage. So when you're accumulating things, and many of you have 401ks, which are very famous for people getting their contributions matched by their employer. That's a great thing that they do, but they also do something also really great. And they allow you to do something called dollar cost averaging. What does dollar cost averaging mean? It's just a fancy term that says, well, you put in the same amount every month, and that's what you do in your 401k. And when you're doing that, the market's going up and down all the time. So what happens is you put money in, and then you are basically buying either high or low. Now, when you buy high, you're going to buy less shares. When you buy low, you're buying more shares. Well, that concept of doing that consistently over year after year will give you a larger nest egg, as we talk about. It always works out for your benefit. Okay, so that's the accumulation phase. Now, there's a fancy term called deaccumulation, which is the phase you get into when you are going to retire. And that means it's the reversal, as the Investopedia says, the reversal of accumulation as by selling the assets of a business. So you're pulling your assets out. And that's the example they gave. In this case, you're going to be seeing that coming from your 401k or IRAs, whatever the case may be. At that point, you are selling, not buying. So that's the opposite of getting a larger nest egg. And how does that work? So think about the good years we've had. We've had the longest bull run of all time before all this happened in 2022. And what happens is you uh, were just doing great. Now it's time to start selling, and heaven forbid that you're going to retire this year, because when you're selling and not buying, which what you were doing, you were buying during the accumulation phase. Now you have to sell those assets to live on, most likely. And when you sell those and the market is going up and down, and it goes up, you have what we call profit taking, because you sold those when they were at high level. Now, just imagine 2022 happening and it's time to take the money out again. When you pull money out at that point in time, you are now taking on what they call a loss, because you're losing money. So let's just say, for instance, that you have lost 15% this year and you needed 5% from your account. Well, what happens is that's a minus 20% in your first year of retirement. Now, how does that make you feel? You're already 20% through your retirement savings in that case, and you're hoping, boy, the thing's got to start coming back. So we're going to continue on with this and your New Year's resolutions and what we can do to help you keep those. And we'll be back here in the next segment in a few minutes. Again, this is Jeff Holmes with restassuredretirement.com. That's where you can go for the free consultation or call in at 480-454-9191.